Welcome, guys. Today we are going to do our first interview for our channel. I'm here today with Michelle Marki. She's an investor and a YouTuber too. She has a channel, Michelle Marki Investing. I recommend it to you all. So let's start with the first question we have today for Michelle, which is, how did you start investing? And looking back at your childhood, why do you think that you got interested in this world?
Well, thank you so much, David, for having me, and I'm so grateful to talk with you today. And I admire what you're also doing in your YouTube channel. So I want us both to be awesome investors. And back in my childhood, I was always very interested in saving money. Like when my parents or grandparents or other family members gave me money, I like to hold on to it and not spend it too much. Like I had like a little piggy bank, and I like to collect the money to save it up for a big purpose someday, like say buying a car. So I was able to buy a car when I was 17, and so some of that lesson of
That's illegal in Portugal.
oh really? Oh funny.
Yeah.
That's funny. Yeah, so I that was like some of my goals. Like I learned, okay, if you save money, you make it grow so you can save it for a goal. And when I was a teenager, my goal was to get a car. And then I also learned from my cousin and my uncle who they invested in the dot-com bubble, and my uncle lost some money, so he was telling me some stories about oh, like all the stock market things that happened during the dot-com bubble in the early 2000s. So, that was an interesting lesson to me. And my cousin also told me about how to save for retirement. So, in America, there are some investing accounts that are specifically for retirement. They are what they call tax advantage, so that you're not taxed as much, or you're taxed a little bit less depending on which way you want to put it in. Like either you save on taxes up front or you save on taxes later. So you have a choice, but either way, it's a nice motivator to encourage people to save for retirement. So I thought, well, that's a good idea. And also, when I was a teenager, like your age, at 16, I went to work for Starbucks, and then at Starbucks, they also gave me this option to say, oh, you could participate in buying the Starbucks stock. So even though I didn't know what was really going on and I wasn't sure if it's a good idea, I participated anyway. So a little bit out of my paycheck every now and then, the Starbucks would take out some money, and then I would, somehow get stock in my brokerage when they would buy it once in a quarter. So around like 17, 18, somewhere in there, I started buying through the Starbucks program, the Starbucks stock as an employee. So that was cool because that was, to this day, I still own that stock. So it's great when you can start buying stocks as a teenager and then you just hold on to it and you don't sell. Because if you don't sell, it can grow, amazingly. So like that was a great lesson to me of the power of investing and owning a stock for more than 10 or 15 years. And if you can do that, and if it's in a good company, then it will be hopefully worth it, like as long as it's not a bad company. So yeah, those are some of my early experiences. And I just thought it made sense. Like I liked the idea of compounding money. And I also realized I opened my first retirement account as soon as I was allowed to by myself at age 18. And I thought, like, I'm going to save early. Like, I don't want to retire when I'm old, like in the 60s, 70s. I want to try to retire from work early in life if possible. So to me, that was something that I was very much looking forward to. So I feel like I was a little bit like you, like wanting to get ahead in this investing world a little bit early in life.
Oh, that's amazing. That's amazing. I heard some great stuff. Uh, we should bounce to Starbucks actually, because I was very interested when I watched your videos. You talked a lot about Starbucks, and
Okay.
I actually did some research about the stock and the valuations and stuff. How do you feel about the current valuations and multiples of the company and the performance and all? What's your take on it, let's say?
Well, I think it was a little bit on sale not too long ago when it was in the $70 range. but I hadn't done that much updated valuation on it, but it's gone up since then. And I think there's a lot of great progress. Like they're soon having the new CEO. I don't know if they already they probably already took over, but like from Howard Schultz again, who came back as an interim CEO for the third time to help guide the company, and then the new CEO I think came, so now they're making more changes, and I think hopefully it will be good. So yeah, I think even though I'm not paying too close attention to it, like I just sort of leave it in the background, I think they're doing okay.
Oh, that's great. Because like the last time I saw it, I think it was trading like 33 PE or something like that. And I just assume like they have such a strong branding and moat that it's worth it, I guess. And since you started buying when you were what, 16?
Somewhere around there.
Yeah,
Yep.
somewhere around there, then you must have done good progress on that investment.
Yeah,
Uh,
it's not bad.
yeah, that's great. Great to hear that. And so, more about this stock valuation and how do you look at stocks? Uh, you made some videos about how to look for value stocks. How do you, in the current market, like, do you find bargains? How do you find them? Your investment ideas? Do you have like a reading list of annual reports, or how do you go about it?
Well, some of that is so it's interesting you say looking for value stocks, right? Because that can mean different things to different people. So I try to be careful about that term because sometimes it has a little bit of a negative connotation. Like value stocks, sometimes people think of as like really cheap, like say one example
Graham.
would be if something has a very low PE ratio. So some people might say if it has a low PE ratio and it's not growing that much, it's cheap for a reason. So
Hmm.
I try to be careful about that. So what I'm going more for is say a wonderful business at a fair price, and that's what Charlie Munger talks about too, is you want to get a great business at a fair price. So if you aim for that, you'll get better quality. And even though you're not paying the lower PE ratio of values, like sometimes they're just not cheap in the PE sense, but I use other valuation metrics like based on looking in the financial statements and the annual reports. I pull out some data like if you are familiar with Warren Buffett's concept of owner earnings, that's
Yeah.
one way where you take some pre-tax income, you add back in some of the other financial data like amortization, depreciation, and there's a few other criteria that you add in. And when you add those up and then divide it into, say, some of the outstanding shares, you can arrive at one possible figure, depending on what rate of return you want to get, of how much is okay to pay for a company. So that one I learned from Phil Town, if you've heard of him. He's got a podcast with his daughter named Danielle Town, and I recommend listening to them too. Invested. So I
Could you
think
repeat Philtown?
yeah, Phil Town and Danielle Town, and they have a podcast named Invested.
Okay,
Yeah, and
perfect.
also they also have a book called Invested. So I learned from them a lot of ways to think about companies of measuring it. And they're very much like Warren Buffett and Charlie Munger style. Like they're trying to follow in their footsteps also. So I have them to thank for really influencing me to adopt their style of valuing companies. And there's a few other methods that Phil Town uses, like there's something called margin of safety. He has a formula for that, and also this formula payback time, which uses free cash flow. So those are some of the ways that I use. And also a newer one that I also try to use now is from this investor named Adam Cecil.
Okay.
And Adam Cecil has this book, Where the Money Is, and he's trying to say, okay, we should modernize some of the value investing that Buffett did and apply it more to technology companies because you might know that before Warren Buffett was not so into technology, right? But most of us, we are mostly investing in tech nowadays, like in many of the companies now in our time, they're more tech. So in order to adjust some of the original methods, Adam Cecil provides some more modern valuation techniques and criteria. So I also try to include that. Like he makes an adjustment for the operating margin. So if we do that, instead of only reading the financial statements black and white, you have to mentally make an adjustment of like, okay, based on some other, observations and trends, it should really be like this. So you account for that. Maybe it's better to give the company more credit for what they're doing because they're, say, heavily investing in research and development, and sometimes that's considered more of an expense. So it takes away from what the company is otherwise doing. Like for years, Amazon seemed you know like they don't have any money, like they don't have as much profits because they're reinvesting so much. But that doesn't mean that they're not profitable. Like Amazon's actually a really great company. So in that example, even though some people, if you just look at the hard facts, it might not seem profitable, but it's like secretly profitable. So, you come to appreciate it better when you realize what is the company doing with that money. Like if you really think carefully about how are they allocating the money, that's really important.
Yeah, I remember looking at Amazon like in September, something like that, and even from a fundamental standpoint or like deep value, it wasn't that expensive. So it actually went to a point where it was very cheap, and then I actually saw in the 13F's filings a lot of investors like buying it at that time, around that time. So yeah, that's a good point that you make. And thank you for the recommendation. I will make sure to research that a little more because that's a new concept for me. Besides that, I had a question for you about your style. Like now you mentioned you are more Charlie Munger style, fair prices, like for good
Mhm.
businesses.
Right.
How do you make sure do you have like a margin of safety in those kind of investments? Is it more qualitative and less quantitative, or how do you measure the margin of safety in those
Well,
kind of?
in doing some different valuation calculations, like I just talked about, so I have about three or four calculations I can do. So those numbers will give me a range. Some margin of safety could be like, say, 50% off the intrinsic value of the company. And sometimes it might only be, say, 30% off. So I have to look at that range and decide, okay, this is the possibility. And maybe if I don't think the price will get low enough, maybe I start buying in sooner if I think, okay, this is and met the minimum high level. So let's say a stock is at $100 and that's the higher level of what's acceptable to buy. And then if it goes down more, like say to $90, maybe that's also good. And the lower it goes, the more you want to buy more. So
Right.
I might initially start buying at the higher margin of safety number, but if it goes down more, then it will be good to just buy even more. But like what I learned is not to be too excited as soon as the number hits the higher range of the margin of safety. I should be patient because there's a very big possibility it will go down even more and I have an even better buying price later.
Yeah, and you have to conserve your capital because unlike Warren Buffett, we don't have infinite money. So
Yeah, but yeah, he also has to conserve. So he also has to
yeah,
be careful how soon he buys in because he actually said that he made the mistake of buying too early in 2008, whereas Charlie Munger did it perfectly. Like Charlie Munger bought Bank of America at the bottom in March 2009. So even Warren Buffett can sometimes, we all, we're
yeah.
all not perfect in timing.
Yeah, right. And timing, it's one of the biggest, like most difficult things to do in the market. And some people actually say it's impossible. So yeah,
Yeah. So that's
that's true.
why instead of focusing on timing, you focus on what is an okay price. You don't worry about the timing. You just think about, am I okay with buying this stock at this price? Like, did it meet my criteria of an appropriate enough buy price? Because sometimes it might go a little bit down to that level and then it doesn't come back. Like it will just go skyrocketing after.
Right. Yeah, that's true. And regarding the circle of competence, do you feel more comfortable? You talked about technology, but there's a wide range of technology or retailers and stuff. What's your take on that?
Well, with like technology, I try to, figure out if it's something able to comprehend on my end. Like, so if I'm learning about Google and Netflix and say semiconductors, and I just started learning about semiconductors. So for me, like I saw that Warren Buffett, his company Berkshire Hathaway bought Taiwan
Yeah.
Semiconductor. So I want to see like, can I understand how the semiconductor business works? So what I'm trying to do is just gradually work on that. Like, not I'm not in a rush. Like I just want to take my time and see, if I borrow some books from the library or read articles online, can I be capable of understanding this company? So that's it. That's really important. What Warren Buffett has said is you want to know where your circle is and not go outside of those boundaries because that's when you make a mistake. So yeah, like even I thought like before I made an investment years ago in Fiat Chrysler before it became Stellantis, and I thought like, oh, I think I can understand the car business, and I think it's a good maybe a good value when I bought it, but even though I did my homework and I thought I understood, but the market was not really recognizing the value of this company, and maybe things have changed. Like maybe the market values more electric vehicle companies. And back in that time, in 2018, Fiat Chrysler was still not yet doing electric vehicles as much. So, considering that, the market was discounting Fiat Chrysler more. So maybe I was like, I don't understand enough of the changing trends, even in the car area where there's a lot of changes with the technology in cars, right? Like, because a lot of car companies are trying to compete with Tesla. So I thought, okay, this maybe is not the best investment. So I got out of that one because it's too many unknowns and I don't understand enough of how the industry is changing.
Right, that's true. And even if there's a growth prospect in the future, if you don't know enough about it, you'll end up making a mistake
Yeah.
further down the road. So yeah,
So yeah,
that's
in that
and
sense, for me,
sorry.
Fiat Chrysler was somewhat of a value trap, if you heard about that,
Yeah,
like value trap. So yeah, you can get stuck in a company that you think has some underlying value, but then if the market doesn't recognize that, you can decide how long you want to stay in something that you feel like is, kind of stuck. And it was stuck for a while, but it's gotten better since. But I've moved on from that. I'm no longer, I don't want to be involved in the car industry for now.
oh, that's right. And right now, what do you feel most comfortable in? Like in what, like for example, if one company popped up in your radar, a company, an industry that you would be comfortable right now to make an investment, what would it be?
I think it'd be like a combination of retail and tech. Like
Okay.
I feel more familiar with the big tech and also the consumer products, like, more retail. So, things that are very much more understandable for a lot of people. Like when people want to get their morning coffee and I see all the lines of the cars going through the drive-through at Starbucks, that's very easy for me to understand of like there's a lot of demand. Starbucks is still one of the more popular brands in America for coffee that it's like McDonald's. It's like one of the top, if not the top one that a lot of people go through. So, considering its dominance, it's not like there's some other company that has taken away the moat of Starbucks too much. I mean, there's always more coffee chains and more, but like so far, companies like Starbucks or McDonald's are still at the top of the list of their what they do. So it's interesting, just seeing that. So those are the kinds of things you want to look out for: is who are the best companies that are staying on top, and other people, even though there's other competitors, they're still not quite catching up yet.
Right. Yeah, that's amazing. About this Chrysler investment, Fiat Chrysler, that was a mistake for you, and you actually analyzed it and why did it go wrong? So, how do you go about mistake analysis? How do you look back to your investments, or even how do you take lessons from other people's mistakes?
Well, part of what I try to consider when I looked at that situation, I thought, okay, maybe I was too late to this investment because some years before, another investor I really like is Monish Pabrai. And Monish Pabrai had made a great case for Fiat Chrysler, and I was trying to study, and it made sense. And by the time I invested, maybe I was a little bit too late to the party. So I realized, like, even though I thought it was still a good deal, it maybe was not as good of a deal as when Monish Pabrai invested in it. And then he also took advantage of the spin-off situation when they spun off Ferrari. So that was a great event. Like sometimes when a parent company spins off a subsidiary company like Ferrari, they want to make sure that the new company is strong by itself. So I learned that Monish Pabrai wishes he would have held on to Ferrari instead of Fiat Chrysler because Ferrari ended up being the better company. So that's something to keep in mind is that kind of interesting situation if you see a spinoff. And in a similar way, I saw Monish Pabrai bought Brookfield Asset Management, which spun off also. So that's also something I'm just studying. I have not
Yeah.
invested in that, but I want to learn how that might be a good lesson there. But yeah, basically, I think I was too late to that kind of investment, and I didn't foresee that the market was going to value Fiat Chrysler more. So I thought like this is maybe going to take too long to realize its value if the market wants to acknowledge its value. And so I was feeling a combination of impatient and maybe I should allocate my money in a different way in something that can grow better in time. So yeah, those were some of the factors that I thought about. And I didn't think my math was off. Like I thought my math was okay, but I did not think that the market would appreciate it in the timeline that I thought it should appreciate. And yeah, that's something I like look out for. Is like if super investors who are better than me, if they're getting out of a stock, I'm also thinking like maybe I should question why am I still in this? If someone as great as Monish Pabrai, he's no longer in Fiat Chrysler, so maybe I shouldn't be in it either.
Right, yeah. And it shouldn't be like a straightforward answer, like, okay, if he's out, I'm out. But yeah, at least question yourself. It's very important. Um, and do you use Excel? Like, because
Yeah,
one of Monish's like rules or commandments for investment is thou should not use Excel or make
really.
complicated math or yeah, something like that. So but I think what he means is like one should not use like complicated calculus or stuff like that to figure out if an investment is worth it. So yeah, I'm just like figuring that out because as I told you, I'm very new to this, but I'm just
Well,
learning
yeah, I
the
mean, I
tools.
just use basic Excel. Like
Yeah.
I'm not making macros or too complicated formulas. Very simple math, like
Mhm.
multiplication, division. It's very easy.
Yeah, okay, that's cool. Now that we are talking about like tools and those kind of things, what are like your favorite tools for investment, for
Also,
investing?
yeah, I mean, you can get a lot of the source material straight from the source from the 10Ks, but like sometimes I do that and take information from there, or I just use the free version of Guru Focus and get some, say, the earnings of the trailing 12 months, or some of the growth rates that they have over the last 5 or 10 years. Some of those I might plug into certain calculations I have. So, I just use what's free and available, and if it's not available online, you can usually find at least the last 10 years somewhere online of the annual reports, and then you do your own calculations from the source materials. And otherwise, like there's lots of websites, like some people like to use screeners like FinWiz, or there's so many online things. I like to look up the 13F filings of super investors like on Data Roma or on the SEC website to look up just what are their investments. Like those are just resources, not as much a tool. But there's also some cool calculator tools on Phil Town's Rule One in investing website. So people can also check that out. He has a lot of free resources also, which are nice. So yeah, that's something I encourage people to use. Whatever is as free as possible. And if you really
Yeah.
like something, if it's really useful, then you can pay. But most of my stuff I don't have to pay for. It's you can still do investing without paying, subscriptions to places.
Yeah, and that's an extra cost to your to yeah, that's true. And do you use Value Investors Club, or do you
Not
check
yet,
the
but
write-ups?
I sometimes some people have shared write-ups with me from there, so I might sign up to that. I know it's a 45-day delay that you get the reports, but
Yeah,
it's probably worth it.
yeah, I guess like you get a 45-day delay if you don't write a write-up too. So if you submit a write-up, and I'm working on that but I guess I still too inexperienced for doing a full write-up. But it's cool because Monish and other investors like Michael Burry, that the guy from Wolf of Wall Street,
Yeah.
and Norbert Lu, and so many other investors. Actually, you can find write-ups from them, like back in the days, like 2000s. Monish has a write-up about some of his early investments, and it's very funny to check the process and their thinking process back then, because they weren't that famous at the time.
Oh,
So yeah, it's very cool.
oh, that's a good
So
idea. Yeah.
yeah, you should check it out. And since you have more experience, maybe you could also do a write-up. I don't know if
Oh, yeah.
you.
We'll see. Maybe if I get to that. Yeah. It's a good idea.
Okay, so now that we covered a lot of super investors, I should ask you the question: what have you learned about from super investors, like besides investing, some lesson that you can take to your life or other aspects of your life?
Well, so one thing I learned from Warren Buffett was that if you want to have happiness in any relationship or whatever you do in life, is to have low expectations, because if you have too high expectations, then people will disappoint you. But like if you want to have success in your marriage or your friendships or your relationships with your family, if you have lower expectations, you will never be disappointed because you have low or no expectations, so nobody can make you upset, right? So that's I feel like a good life lesson is, you know, not for us not to expect too much from other people, and just, try to be more relaxed, because that's how we might have a better life situation, like how Warren Buffett and Charlie Munger are in their 90s. So if you keep that less in mind, you can maybe live a very long life.
Yeah, that's true. And they actually eat very bad. So maybe
Yeah.
happiness and stress free life, it's their way to be healthy and live long.
Yeah.
Yeah, that's also one thing that I found very interesting about investing. Do you know William Green, the guy
Yes.
from
Yeah, I
Richard
met
Riser?
him. Hmm.
Yeah. Do you met him?
Yeah, in Omaha last May.
Oh, right. I should
Yeah.
ask you about that. I should ask
Yeah,
you because
maybe we
I
can talk about that in a future video of a future.
Okay, yeah, sure, sure. He's so nice. Like I actually texted him in LinkedIn,
Oh yeah,
and he always answers to me, and he's like amazing. He's right now. I don't know if I can say this, but I will say it. He's in Zurich visiting Guy Spear right now.
yeah.
So yeah, he
But
told me.
Guy Spear is awesome. Yeah, they're both super amazing. Like I'm so grateful to have met them also.
Whoa, that's yeah. We should definitely do a part two about just about Omaha because I have so many questions. Yeah, William Green said that investors are practical philosophers.
Okay.
So because like they actually have to apply stoicism and all these kind of schools of thought
Yeah.
to make profits. And it's amazing how you can learn about life while still learning about investing. And I think both of those things are connected. Okay, I liked a lot this conversation with you. I got some valuable insights and suggestions to dig in more. And I like it so much that I think we should do it again, like talking more about the annual meeting and other experiences with investors that you had. So if you agree, we should do a part two on this one. What do you
Yeah,
think?
for sure, David. Yeah, and if not also part three and more, if we, there's so much I feel like is great to talk about with you, and I'm really grateful that you had me on today, and I'm super happy for connecting with someone like you who also values this style of investing.
Oh, that's amazing. Thank you so much. And I'm the one that should be grateful because like it's very valuable that you are open to share your experience with young folks, and that's one of my goals with this channel. I always like view that the viewers are my friends, my age, so I try to put things simple, and it's very valuable that you are open to have this kind of conversation. So thank you so much for being here with us today, and we'll see each other very soon.
Yeah. Thank you, David. Yeah. Bye.